Many amateur investors look at Ethereum's massive price swings with genuine fear. Professional traders look at those exact same swings and see raw fuel. When you buy spot Ethereum on a traditional exchange, your profit potential is strictly 1-to-1. If the coin's value goes up 10%, your investment grows by 10%. But that mechanic only rewards you if the price is actively climbing. Add in the logistical baggage, setting up external digital wallets, managing private keys, and the constant threat of wallet-targeted exploits, and the process of simply holding the asset gets heavy fast. When the market takes a sudden dive, holding the actual coin leaves you entirely exposed. You have no structural defense against a crash, and your capital is locked into a sinking ship. That brings us to the contract for difference, or CFD. Instead of owning the digital coin, you trade a contract based purely on Ethereum's price movements against the US dollar. This removes the specific vulnerability of digital wallet theft, as you're speculating on price action through a regulated brokerage platform rather than holding the asset on-chain. The defining feature here is leverage. This mechanism allows you to control a market position using only a small fraction of your own capital. With 10-to-1 leverage, $1,000 in your account allows you to control a $10,000 position in the market. And because you don't own the underlying asset, you can engage in two-way trading. If you expect Ethereum to drop, you open a short position. When the price dives, that downward movement directly translates into mathematical profit. But leverage cuts both ways. It amplifies losses at the exact same rate it multiplies gains. Surviving this environment requires a strict, objective method for diagnosing market conditions before you ever click buy or sell. In Ethereum's market, a strategy that works during a quiet weekend can become a liability the moment a major trend ignites. You have to adapt. The first tool we use is the average true range, or ATR. Think of it as a volatility speedometer. It measures the average size of price swings over a set period. It doesn't tell you which direction the price is going. It only tells you how much energy is currently in the market. This diagram shows how we map that energy directly onto the price chart using Bollinger Bands. These outer bands act as boundaries around the price action. Watch how they actively expand and contract, reacting visually to the market's current intensity. By layering the ATR data over these visual bands, the current state of market energy becomes a measurable data point rather than a guess. Let's look at the first state, high volatility. You'll know you are here when the ATR value spikes significantly higher than its recent average, and the Bollinger Bands rip wide open. This chart illustrates the core mechanic of breakout trading. In a high-energy market, you identify a solid ceiling of resistance, and you wait. You only enter the trade when a candle forcefully smashes through that ceiling with absolute conviction. To ensure that upward break has actual strength behind it, we check momentum indicators like the Relative Strength Index. We want to see the RSI aggressively cross its upper threshold right as the price breaks resistance. Once you are in a fast-moving trend, you use a trailing stop-loss. This safety net automatically steps upward as the price climbs, locking in your gains and protecting your capital the second that momentum reverses. When the matrix reads high volatility, you set aside conservative tactics, you trade aggressively and ride the momentum. But eventually, the market calms down. The ATR slatlines and the Bollinger Bands squeeze tightly together. If you try to trade breakouts in this environment, the market will chop your account to pieces. Instead, you switch to range trading. You identify the tight boundaries, buy at the established floor, and sell at the established ceiling. To pinpoint exactly when the price will reverse at those boundaries, we use the stochastic oscillator. When it dips below 20 at the floor or peaks above 80 at the ceiling, it confirms a high probability bounce point. A quiet market is perfectly tradable. You simply stop hunting for massive trends and shift your focus to precise, predictable execution. Getting the direction right means nothing without risk management. Because of the sheer power of CFD leverage, a single unmanaged price spike against your position can trigger an automatic margin call, instantly liquidating your account. Your primary defense is strict position sizing. Professional traders survive by never risking more than 1-2% of their total capital on any single trade. Look at this split-screen comparison. Traders enforce that rule using dynamic stop losses based on the ATR. By calculating your stop distance based on current volatility, You take smaller positions in chaotic markets and larger positions in quiet ones. Your total financial risk scales perfectly, staying locked at that exact dollar amount, regardless of the market's mood. You also have to account for the hidden structural costs of holding trades. This means factoring in overnight swap fees and planning for the very real danger of slippage, where the price you click isn't the price you get during major news events. Professional trading is rarely about predicting the future. It is entirely about mathematically capping your downside exposure in the present. That is the complete workflow. You objectively diagnose the volatility, select the exact strategy the matrix calls for, and lock down your leveraged risk with hard math. Now it's time to build the muscle memory. Put this systematic matrix to the test risk-free and master the mechanics of Ethereum CFDs by opening an FXNX demo account today.